Good morning, taxpayers. My name is Vladislav Grant. I'm a tax attorney here in the state of Florida and servicing tax-related matters nationwide. And today is July 4th, 2025, the Independence Day. But what's more importantly, today we are signing the One Big Beautiful Bill. And let me blitz you through the most important items that are affecting individuals in coming years from the tax perspective. So without further ado, I'd like to turn you over to my presentation mode and we will go through what we are seeing on the screen. It is the One Big Beautiful Bill. And at the moment, I have an introduction of the series of videos I'm going to be producing for businesses, for individuals, and the states. So I will also be providing strategic planning and action items that you can utilize in order to optimize your taxes in upcoming years. In this video today, we're going to focus on part 1 of income taxes and specifically focus on the individual taxpayers. In the next video, we're going to focus on corporate and business tax changes, then the international tax reform, and some of the retroactive limitations for employee retention credit under the new Big Beautiful Bill. And in part 2 of this video series, we're going to review the estate tax provisions, which we'll talk specifically about the estate tax reforms and how you can plan your inheritance and legacy. And then along all of these, I will be providing strategic planning action items and how you can prepare for upcoming years and what you can do in order to save taxes and plan for your future and preserve wealth. Thus, let's move over to the very first item that I'm very excited about the One Big Beautiful Bill is the state and local deduction. The One Big Beautiful Bill introduces a temporary increase in the SOL deduction from $10,000 to $40,000, essentially primarily benefiting taxpayers with incomes below $500,000, particularly in the high states. It's set to revert back to $10,000 in 2030, and it disproportionately technically affects taxpayers in high states like New York, New Jersey, California, Illinois. Now, if you have a house and you are paying a massive tax bill on your property, that is generally the one that eats up the most of the state and local deduction per year. Now, if you are a more affluent American and you are in line with your property taxes being over $10,000, you might be very, very happy. So now you're able to max out your property taxes up to $10,000 or any other state and local taxes that you may be paying throughout the year. So this is the time to really look over your mortgage statement to look how much taxes are going into your payments and look at your end of year bill from the state and local authorities. So at the moment, this is one of the most anticipated items that everyone has been talking about and waiting for. Now, we're moving forward to the second most important thing that I think is on this list, and that is the standard deduction. Now, the standard deduction stays and actually is increased and made permanent with enhancements. So starting in 2025, the deduction will increase to $31,500 for joint filers, $23,625 for head of households, and $15,750 for other filers. Also, it will be inflation adjusted thereafter, so you are never losing on the true value of the standard deduction. And effectively, it lowers taxable income for individuals, and I would suggest that you compare actually whether you are able to itemize the deductions more effectively than standard deduction because it's already so high. Sometimes you don't have enough itemized deductions or records to support your itemized deductions that sometimes the standard deduction is your real way out. Now, without further ado, but I would like to say that standard deduction also gets another enhancement based on your age, because if we're looking at the senior deduction, there's an addition. This particular bill also temporarily adds a senior deduction of $6,000 for each qualifying individual for both itemizers and non-itemizers that phases out when modified adjustment gross income exceeds $75,000. And again, it's available from 2025 through 2028. So it means that it doesn't matter whether you're actually qualified, it doesn't matter whether you're actually itemizing or non-itemizing. If you're of age and you qualify, you get $6,000 automatically, which means that works in conjunction with the standard deduction on top of what we have here. So you're looking at, if you qualify by age, at about $37,000 in standard deduction if you are of age. This is huge. This is huge for seniors in America. Now, let's move on forward. The next other thing that I see in this case is the itemized deduction limitation. Now, that particular limitation is actually for the highest earning individuals in America who are in the 37th percentile of tax brackets, which means that they are in the highest tax bracket there is. So what it means is that the One Big Beautiful Bill, although allows a higher deduction for a lot of individuals, let's say on the state and local, but it's limited to 35 cents on the dollar for taxpayers who are actually in the highest tax bracket, which is the 37%. We will go specifically in details on what the tax brackets for this year will be in a separate video, but this puts additional burden on high earners in achieving meaningful itemized deductions and sometimes forcing them to actually take the standard deduction in general. So I would suggest that a lot of the high earners in the United States who are making $300,000 or more actually estimate their income at the end, during the year actually, and see what tax bracket they will fall in. Because the difference between actually itemizing the limitation, itemizing your taxes versus taking the standard deduction is huge. So I would say that you need to get on the phone with your tax planners, with your tax accountants, and ask them these questions. Next in the line, we have charitable contributions are now above the line. Well, now the section 70424 of the Senate bill, which proposed a permanent charitable deduction for taxpayers who do not itemize their deduction, will now be a permanent line for people that are taking a standard deduction. So assume you are making a contribution, charitable contribution to church, to any other qualified nonprofit organization. You are now allowed to take that contribution along with your standard deduction, when that was previously not allowed because this was exclusively reserved to an itemized item. So now what you have is a guaranteed addition to your standard deduction if you're making these charitable contributions. They are capped at $1,000 for individual filers and $2,000 for joint filers. Now, effectively, it reduces your taxable income without itemization election and essentially increasing your standard deduction. So document and track your charitable contributions throughout the year and take advantage of this charitable contribution line that will be technically above the line. We'll explain what that means in the next video. But next on this particular list, we have mortgage interest deductibility. This one is not very hot one, because if you are a high earning individual and you have a house which is worth more than $750,000 and you owe more than $750,000, there's a limit on the interest deductibility if your principal exceeds $750,000. Essentially, it disallows a wealthy American taking advantage of interest rates deduction on expensive homes, and I would suggest that you review your mortgage agreement. You will usually see how much you have loan outstanding, and therefore you'll be able to calculate the mortgage interest deductibility rather quickly. But this one is targeted towards wealthy Americans. It's usually not really well received with the higher end community, but it doesn't really affect anyone that is below this threshold at $750,000 for their home. Therefore, this one is not really a big impact on regular individuals, rather just wealthy Americans on this particular landscape. Now, let's move on forward. Gambling limitation. Now, who of us is not a little bit of a gambler in life, right? The new law under the One Big Beautiful Bill essentially makes a new limitation on the losses. So imagine you go to, casino, you win $100, and then you lose $100. Now you're only allowed to deduct $90 from the $100 that you won. So, which means that you still owe the IRS even though your money is out of your pocket. Which means that if you win money and then you completely lose it, you also will owe to the IRS just for playing. So essentially, it disallows gambling Americans taking advantage of a usual 100% deduction of the losses against the winnings, which essentially, tries to target Americans who are got gambling addiction, because then they're not just only mortgaging their properties, now they also owe taxes on it. So I would say track your losses as well as you track your winnings, and hopefully you have more losses than you have your winnings that can cover your winnings. But I genuinely hope that nobody actually has gambling addictions. If you do, please seek some help. But at the end of the day, I wish everyone wins, although that doesn't really happen. But remember, if you win and then you lose, you still might owe taxes to the IRS. And remember, the casinos never report your losses. They really only report your winnings to the IRS. So you are in charge of reporting your own losses. If you ever need help tracking them, please call me at 561-858-1288, and I will provide you with a software which can help you track your gambling winnings and losses. Next in line, we have no tax on tips. This is one of the biggest ones and most anticipated promises by Donald J. Trump. The One Big Beautiful Bill makes $25,000 of tip income deductible for individuals in traditionally and customarily tipped industries for tax years of 2025 through 2028. Deduction phases out at a 10% rate when adjusted gross income exceeds $150,000 or $300,000 for joint filers. Now, what does that mean? It essentially lowers your taxable income for individuals in the tipping industry. Let's say you are a waiter. Now, the reality of this is that waiters are terrible with actually reporting their income. And this particular bill is not really aiming at fixing the problem of waiters or people in the tipping industries to, actually disclose their taxes and disclose their income. It's really aiming to help them qualify for mortgages and other loans out there that when they get reviewed for their income. Because in reality, when you have individuals in these industries, they are terrible at reviewing and actually reporting these particular incomes to their accountants anyways. But what this is doing is it creates the same effect up to $25,000, which increases their income for the demonstration purposes. But effectively, once you demonstrate the $25,000 tip income, you get to deduct it on your tax return, and essentially it gets washed out. So it looks better on a tax return that individual actually makes more money, which is a true up. But again, it doesn't have a ultimate effect of making that tip income taxable, and it doesn't have the effect of actually solving the problem that when the people in these industries actually report the right amount. Because I can guarantee you, if there's anybody who is in tipping industry makes over $25,000 worth of tips, they're most likely not going to give you the right number on how much tip income they actually receive. So this is a nice little wash that is provided by this particular language of this bill. It doesn't really solve the problem. It just helps these people to qualify probably for better mortgages and better loan rates. And the same thing with the overtime, and which is the next thing on our list. The One Big Beautiful Bill makes up to $12,500 and $25,000 for joint filers on premium portion of overtime compensation deductible for itemizers and non-itemizers for tax year of 2025 through 2028. The deduction again phases out at 10% rate when the adjusted gross income exceeds $150,000 or $300,000 jointly. So it's the same thing I just said about the tips. It's just making this increase in income artificial for presentation purposes on your tax return, but then it actually phases out. However, here overtime is usually very well tracked because it is part of the W-2 process. It's usually for the workers who have salaries. So as a matter of fact, this particular overtime is likely going to be well tracked on the payroll service. So this is where I think we are going to see a good improvement in control of actually taxing amounts that exceed this $12,500 or $25,000 limit. So at this point, I think this is a more fair and honest piece of legislation than the one on tips, because tips, we know we will never get the proper number from the actual individuals in that industry because they never track it properly. So I suggest that you accurately track and disclose your overtime income and deduct it on your tax return, and actually pay tax on the amounts that are over that amount. And last but not the least, in line of this particular one big beautiful bill, we have auto loan interest. The bill will temporarily make the auto loan interest deductible for itemizers and non-itemizers for the new autos with final assembly in the United States for the tax years of 2025 through 2028. The deduction limited to $10,000 and phases out at 20% rate when income exceeds $100,000 for single filers and $200,000 for joint filers. Now, effectively, it'll lower the taxable income for individuals. So I suggest that you accurately track and disclose the interest on autos, deduct it on your tax return, and I would also check whether or not the new autos and final assembly provisions will apply to you. I will have a whole separate video on auto interest loan because this is an interesting item that has not been previously proposed to any legislation in prior years. This is absolutely new for the tax code, and I would like to specifically have a separate video where we go in depth of what does it mean to have a new auto with final assembly in the United States, so that you do not miss out on this particular deduction. Now, in the next video, we're going to review the income taxes and the impacts on corporate and business tax changes that are in the big beautiful bill. Without further ado, I would like to remind you that my name is Vladislav Grant. I'm a tax attorney here in the state of Florida. I practice tax law and I provide tax accounting services across the United States. If you have any questions, please call me at 561-858-1288. Subscribe to the channel, put a like on this video, and share with your fellow taxpayer. Again, my name is Vladislav Grant. I'm wishing you a great day, and I'll see you soon. Have a good day. Bye-bye.